Now it's time to actually turn to the arithmetic of portfolio management. And so what we've got in front of us now is portfolio management risk and return. In particular, we're going to be looking at part one. So what we'll see here is sort of the basics. So it's going to be a little bit rudimentary. And in particular, it is something that has lots of overlap with study session 2. So if you go back to the quant material, a lot of this we will have already covered. I'm going to go ahead and go through it and we'll talk about it, but if you feel like, haven't we already seen that? Well, in fact, we have seen it before, so it's something that, yeah, you've seen before, but that tells you that if they're putting in here twice, well, it must be important, right? So anyway, so let's just jump in and see what we can learn about the material. So return measures. The first one is holding period return, and of course, we've talked about this in several places, and sorry, wrong tool with that. You've got to get to where you can see this in the formulas that you're looking at for the exam, those types of things. The way this gets written is that the holding period return is equal to what we see here, P1 over P0 minus 1. Okay, you're also going to see it as being equal to P1 plus D1 over P0 minus 1. And then, so this is just the dividends or the cash flows you receive. Here we're assuming there are no interim cash flows. So it's not that it's different. It's just that this is if we're allowing for interim cash flows. And then we could also see it as P1 minus P0. What's that? That's capital gain, plus any cash flows that came. So D for the cash flows. All divided by P0, and notice that we do not have to put on a subtract 1 over here, right? So anyway, so all of these say the same thing. They're all holding period return, and this is a calculation that's just all over the curriculum. So, if you're going to buy something for 10 and sell it for 12, well, you calculate the return. That can apply to one day, 1 month, 1 year, 20 years, whatever it is. Whatever the holding period is the time between the observation of the prices. Average return. So if we're thinking of the average return on a portfolio, well, what is the then we can take the return of each of the individual assets divided by n, assuming that they were an equally weighted portfolio. This is simply an arithmetic average, not anything that I think is surprising to anyone. Okay, geometric return, we've seen this before, but again, the problem here is that compounding thwarts the idea of arithmetic return. So if we look at a 2-period investment, so that says time 2 there. If you start with $100 and you go to $200, okay, well that means you had 100% return in this period, right? And then if you go from $200 back down to $100, well you had a minus 50% return in this period, right? Well, if you calculate the arithmetic average, you take 100 plus a negative 50 and divide it by 2, well then what you get is 25%. So do you feel like if you started with 100 and end with 100 that you were earning an average of 25% per year? Well, no, you don't, right? So what the arithmetic return does not allow for the compounding effect, the geometric return does. So the impact of investing and earning 10% 1 year, 12%, minus 2%, 4% for however many years, okay, well, that's what the geometric return is telling us. So you may have heard that large cap stocks in the United States over the last 60 or 70 years have had an average return of 12%. And then you start thinking, well, if my great grandfather had invested $1,000 for me, for 60 years at 12%, how much money would I have today? Okay, well, you would be a happy camper if you did that calculation, of course. But that would not be what you actually had, right? This 12% is an arithmetic return. The geometric return is going to be lower than that. It's closer to 10% or something like that, 10.2 or something. Anyway, so the point is, arithmetic returns, if there's any variation, okay, if we take, if we want to average 2, 2, and 2, it doesn't matter if we take the arithmetic or the geometric return. But if you want to average, 4, 0, and 2, so now we have, variation in the time series. Well, the arithmetic return will always be higher than the geometric return. So this is something that I do think will show up on the exam. So I would make sure that I could work with these geometric returns before I went in to sit for the exam. Easy questions. Your job, of course, job 1 is to get all the easy questions. Money-weighted returns. So all this is, it is internal rate of return. So we use this calculation a lot. It's the return that is internal to the cash flows. We call it the yield to maturity if we are dealing with a standard coupon bond. We call it the money weighted return if we're talking about evaluating a money manager, but it's all the same thing. Okay, that is, it's just the internal rate of return. That's I suppose the base name or base case for it. And we've got cash flows. Okay, so you're thinking of cash flows in and out of your pocket here. We're going to set all that equal to 0 and solve for the return. So just an internal rate of return. And what we're going to see is it's going to be influenced by when money is in the accounts and those types of things. So as an example, we invest $1,000 at time 0. So let's think about this. We'll come down here. We're going to invest $1,000 at time 0. And by the time we get to time 1, it's grown to $1,200. So that means that we had a 20% return. Okay, that didn't look very good. We had a 20% return in the first period. So that's time 1 and this is time 2. Okay, and then we're going to add $800, right? So we have $1,200. We're going to add $800. So we're going to have $2,000 invested at the beginning of the second period into the first period, and it grows to $2,200. We're going from $2,000 to $2,200. This is plus 10%, right? So if you calculate the arithmetic return, you're going to get 20 plus 10 divided by 2 is equal to 15, right? So the arithmetic return is going to be 15%. What's the money weighted return? Is it going to be higher or lower than that? Okay, well, it is the money weighted return. So we're weighting towards where there is more money. Notice that you have more money in the second period, right? In the first period, you only had $1,000 invested. In the second period, you had $2,000. You had your $1,200 from the first period plus another $800 that you put in. So you got $2,000 at play at the second period. We're going to be weighting towards the period where you have more, we're going to be weighting towards the period where returns are lower. So what we better see when we look at the calculation is that the arithmetic return of 15% is higher than the money weighted return because we should be weighting toward period 2 here, right? And if you get the equation, we put in 1,000, we put in another 800, we take out 2,200. Be careful to think of this as cash flows and not balances. Then we solve for the discount rate, and what we get is 13.62%, which of course is less than the 15% arithmetic return. So money weighted return, just an internal rate of return. You saw, no one's ever going to do this on their calculator that's going to pass the exam anyway. You're going to plug into your calculator, use your cash flow functions. I'm not going to talk about that here, but if that bothers you, okay, calculator stuff is still a little befuddling, okay, then job 1, okay, is to get that calculator, the calculator you're going to use on the exam, and start working problems, right? So it'll be just like this. We're going to put in the $1,000 outflow, the $800 outflow, and the $2,200 inflow, solve for the internal rate of return. So using the cash flow functions on your calculator. All right, so money weighted returns there. Okay, what about other return measures? We can think gross returns, though that's before management fees. Net return, of course, is after management fees. Taxes, the government's going to be in there with all 4 feet, so if we account for our tax liability. Real return is when we're going to adjust for inflation. I want you to pay particular attention to that one. And then leverage return means the return on cash invested. Okay, so, and we can have all of these come into play in a single question, right? We could think about, the fundamentals of the security. It changes in value, but we're using margin and we have to pay taxes and there's some inflation and all those types of things. So we can have a problem like what you see here that actually gets fairly involved. So we have an investor who's going to buy 500 shares at $35 with 50% margin. Remember what that means. They're going to put up half of the value and they're going to get a loan for the other half. So the 50% margin means that for a $35 share, they're going to have to put up how much? They're going to put up $17.50, right? After 1 year, the shares are going to be sold for $50. Okay, there's a 15% tax on these types of gains. Inflation was 4%. We're going to ignore interest or commissions on that loan, so we're going to put up $17.50. We're going to get a loan for the other $17.50. We're ignoring commissions. We're ignoring interest, and we want the after-tax leverage return, but we also want to have the real return. So we want to account for this 4% inflation. So what does that mean? Well, the fundamentals here, okay, our leverage, what we bought something for $35, sorry, that's going to be, P0, that ended up being worth $50. So that's P1, so that's the capital gain on each share. But the P0 for our investment here in a levered return is not equal to 35. We only put up $17.50, right? So the levered return is equal to 85%. Okay, well, you start out there and you think that's well, pretty sweet, 85% return. Okay, but now we've got to account for the fact that the government return, multiply it by 1 minus the tax rate. I'm going to get rid of some chicken scratch. Okay, it's going to give us a 72.8% return. And what I want to draw your attention to in going from after tax to real is that there's a temptation to say, okay, 72.8, let's subtract the 4% inflation and get 68.8. Okay, but that doesn't allow for the compounding effect. So what we need to do is we need to divide this by 1 plus the inflation rate. So the real after-tax levered return is going to be 66.2%. Again, take note of how we're adjusting for the impact of inflation. All right. Okay, so that is looking at those different return measures. I don't think there's anything there that should scare you. It's just something you want to make sure that you can think through. You understand what we're talking about when we say margin, how to adjust for taxes, how to adjust for the inflation, and you're ready to go. Major asset classes. So this is just some data on the different asset classes. So small cap and large cap stocks, as you would expect, perhaps. Small cap did better than large cap, but also with greater risk. Come down here, you can look at what's happened with inflation. It's been 3% with a 4.2% standard deviation. Okay, T-bills, well, you would expect T-bills to be less than Treasury bonds. Okay, well, that in fact happens. You'd also see lower risk. The surprising thing here to me, and I haven't gone back to verify this independently, but I wouldn't doubt it for a particular period, is that what this shows is that corporate bonds outperform Treasuries, which you would expect in terms of return, but also had lower risk. So anyway, lower standard deviation. We're still going to cling to what it says in all the textbooks that U.S. government obligations are risk-free. This, of course, that means default risk-free. Anyway, this is it's anomalous. It's an interesting fact. Of course, it comes from Ibbotson, so I trust Ibbotson. I just don't know the time period on it. So mean, variance, and covariance. Again, this is straight up review from study session 2, but let's take just a minute and go through it. All right. So we're going to have to calculate them in this order. You got to have the mean to get the variance, okay, and then the variance will feed into the covariance in many cases. All right. So we have 3 years of observations, 2 assets, A and B. A, 5 minus 2 and 12. All we're doing here is finding the arithmetic mean. So 5, negative 2, and 12. Add them up, divide by 3. Arithmetic mean return for asset A was 5%. For asset B, calculated the same way, 7%. All right, so just calculate all we're doing is calculating the mean return. Okay. Now, what about moving to covariance or moving to variance and standard deviation? Well, remember, for asset A, and we don't have to think about asset B to understand what's going on with asset A yet. So we're still just talking about the variance of asset A. Well, what we're going to do, we know that the mean return is 5%, right? So the mean here is equal to 5% for asset A. Okay? Well, we're going to take every observation and we're going to compare it to the mean, right? So we're going to take the outcome in the first period or outcome in period I and subtract off the mean return, okay? And we're going to do that for every period. So you can see that this is going to be, 5% in the first period minus a 5 mean, minus 2 minus 5, so this is going to give us minus 7. So this is going to be 0. That'll be easy to work with. And 12 minus 5, so that's going to be 7 here. Okay, well, if we did this and we just added them up, okay, well, what we would get is 0 in the numerator, right? Because some of the observations are greater than the mean, some of the observations are less than the mean. Okay, but what we do to avoid that is we square all of these terms, right? So we're going to take the deviations from the mean. Okay, the return in each period minus the average return, that's the deviation. We're going to do that for each period and square it. Otherwise, it comes out to 0, right? So take it, square it, and then we're going to divide by n minus 1 under the assumption that we're working with a sample here. If we were working with a population, this would be just divided by 3. Sample, it's n minus 1. So quick reference to going all the way back to study session 2 there. But when we do that, we divide by 2, we get a variance for asset A of 49. Okay. Well, what's the problem with that? Well, the problem is we squared all these deviations, right? So this is in units squared, and units squared. When do you use units squared? Well, I guess if you're a variance user, you're using units squared. When you go to your high school reunion and you're talking to those girls that wouldn't date you or boys that wouldn't date you, and you talk about your income, you might use income squared. Anyway, so the point is we want to get this back into its original units, so all we got to do is take the square root. So the standard deviation of asset A is 7%, and determine similarly for asset B would be 11%. So what we see now is we know the mean returns, covariance. Now think about the variance formula here. So we're going to take each return minus its mean and square it. Okay? When we calculate the covariance, we're going to take each return minus its mean, but then instead of going and adding a square here, we're going to take these paired observations. So this is 5 and this is 7. That's our paired observation. We're going to compare them to their means. That is, we're going to take the observation minus its mean, observation minus its mean, and we're going to take the product of that, right? So we have the difference here, the deviations from the mean for both series, and then we multiply those together. Well, if this is, well, let's see, we'll come over here. So we get minus 2 minus 5, so that's minus 7. We get minus 4 minus 7, so that's going to be minus 11. Well, we've got minus and minus, right? So if we have a negative and a negative, well, a negative times a negative gives us, of course, a positive, right? Okay, and here we're going to have a positive and a positive, so a positive and a positive gives us a positive, and here we end up with 0. But the only time we're going to get a negative term here is when one of these things is above its mean and the other is below. So to the extent, in a very real sense, what we're measuring with correlation and covariance, as well as the magnitude of this, is when these things are above their mean at the same time and below their mean at the same time versus the opposite, when one would be above their mean and the other would be below. All right? So anyway, when we do all that, we're going to get to 0.0077 here as the covariance. What's the problem with the covariance? Well, the problem with the covariance is it's defined by negative and positive infinity, right? So it's a positive number, so 0.0077. I know that means that these tend to move together, but all I can really tell you about that just by staring at it is that if you had told me it was 0.0066, that would be less tendency to co-move, right? So the higher the number, the greater the tendency to co-move. So, but if it's 0.0066, less tendency, but still, I don't know how to interpret that in terms of building portfolios. But what I can do, and by the way, up till now, calculating mean, variance, covariance, important, okay? But what is absolutely fundamental is this equation. So I'll put an FS here, make sure this goes on your formula sheet, the other stuff as well. But what we can do is we can take that covariance, divide it by the product of the standard deviations, and get correlation. Correlation, of course, is bounded by -1 and +1. So +1, these things move up and down in perfect linear lockstep. And so linear function of one another, if you want to think of it that way. Think of it as moving up and down together in lockstep. Okay? And then -1 would say they're moving exactly the opposite directions, right? 0 means there's no identifiable linear correlation. Between 0 and 1, positive and imperfect. Between 0 and -1, negative correlation and imperfect, right? So we run the gamut from -1 to 1, and the closer we are to 1, the stronger the tendency to co-move in the same direction. To -1, the stronger the tendency to co-move, but in opposite directions. All right? So in this case, if we plug in our data that we got from our little example, we would find that these things are perfectly positively correlated, something that happens very rarely in the real world. Okay, so at least if you're not talking about derivative type securities. All right, so risk aversion. Yeah, I want you to be really careful to understand what we mean when we say risk aversion. So the big thing here is that you do not confuse it when we're talking about portfolio theory especially, but you cannot confuse this with risk tolerance. Okay, so my parents have less risk tolerance than me, and I probably have less risk tolerance than you if you're a typical 22 to 35-year-old CFA level 1 exam taker, right? Just because of life cycle impacts. So we can have different levels of risk tolerance. Risk aversion is a characteristic that applies to all investors, okay? And all that says is that, given the same return, okay, if investors are offered a choice of 2 investments with the same expected return, they take the one with the lower risk, or the same risk, they take the one with the higher return. So we're not in the business of minimizing risk, we're in the business of optimizing the trade-off between risk and return. But if we just wanted to minimize risk, well, that would be really easy. You would just buy treasury bills or whatever you thought was the lowest risk security. So risk aversion just says that it's a principle that applies to everybody, at least in this world. You have to abstract from any gaming type enjoyment. So you people go to Las Vegas, or you observe people go to Las Vegas, not you people go to Las Vegas. You observe people go to Las Vegas and they'll gamble, and that has a negative expected return and all that sort of. Does that mean they're not risk averse? Well, no, it just means that they like being in the casinos. Anyway, so we're talking about just pure portfolio incentives now. All right, so this is actually a good question, and it drives home this point, I think, very well. So Abner is risk averse, which basically says that Abner is a Homo sapien. Which of the following statements is most likely correct? So I'm going to pause for about 3 seconds, and I'm going to let you think about the answer. So he will choose relatively safe investments, he may hold some very risky investments, or his risk tolerance is relatively low. So given that he's risk averse, and that's all that we know about him, okay, which one of these 3 things is true? Did you come up with an idea? Okay, I want you to write it down on the paper you have there next to you, because otherwise you're going to say afterwards, oh, I knew it was what he said. Anyway, so take a stand. All right, so here's the idea. His risk tolerance is relatively low. Okay, the person you know with the lowest risk tolerance is still risk averse, right? At least that's the theory. If you don't believe it, well, believe it for exam day, all right? It's pretty close to true if it's not true. So this is not right. We don't know anything about Abner's risk tolerance. All we know is that he's risk averse, which says he's a human, right? Let's see, he will hold relatively safe investments. Okay, well, again, relatively safe, well, relative to what, I guess would be a good question, but again, that's a function of risk tolerance. So the only answer that would make any sense is he may hold some very risky investments. So he's risk averse, but he still may hold some very risky investments, particularly if he understands portfolio theory. So once again, risk tolerance, risk aversion, okay, I don't think you want to get those things confused, especially not when we're dealing with the portfolio material, all right? Okay, so this is the equation, we've seen this before, for the variance of a portfolio. In particular, this is the variance of a 2-asset portfolio. Okay, it can only be used for 2 assets because it's actually, this comes from a double summation thing. So as your assets increase linearly, the length of this formula increases geometrically. Anyway, so looking at it down here, which is the way I like to conceptualize it, what we're saying here is if we have 2 assets, we know their standard deviations, we know the portfolio weighting, okay, and we know their correlation. Okay, then we can calculate the variance. Once we have the variance of the portfolio, okay, sigma squared of the portfolio, well, we just take the square root. Once we have a variance, we just take the square root to get the standard deviation, right? So this is something that you definitely want on your formula sheet. Okay, I'd be very surprised for you not to see this on the exam, probably more than once. But anyway, let me point out a couple of hazards to you really quickly. Notice that at the end here, we've got standard deviations, but over here we have variances. So you've got variances and standard deviations in this formula. Here you have weights, and here you have weights squared. All right, so you've got weights and weights squared, you've got variance and standard deviation in the same formula. Of course, you have to know the correlation, and so you got to be on your toes when you're actually implementing this. The point being that if you look at it and say, oh, well, of course I can just plug into that formula. When it shows up on the exam, I'll get those points right. Just try one. Humor me, just to make sure that you don't mess up on inputting the data and that sort of thing. But other than that, okay, when you get the end result, it's a variance. It's a variance just like any other variance that you'd calculate. All right. So variance of a portfolio. Again, this is something that you do want to have on your formula sheet. Notice that the 2 versions here. If we take that formula we saw a minute ago, which said the correlation of A and B was equal to the covariance of A and B over standard deviation A times standard deviation B. Well, if you solve this equation for covariance, then this is what you get, right? So the covariance can go up here, or covariance can go here. So this is just 2 ways to present the same data, right? Or to present the same concept. And you don't know how they're going to give you the data on the exam, so you need to be nimble enough to understand that you need covariance on the end, but you may have to calculate it from the correlation, right? So you got to be ready to deal with whatever comes your way. It's likely the case, again, that if you need one thing, they'll give you the other, right? If you need standard deviation, they give you variance. So be careful when you're implementing the formula, I guess is my point. All right? Okay, so portfolio standard deviation, a quick example. So what we have here is a portfolio with 30% in stocks, okay, that have a standard deviation of 20%. The remainder in bonds with a standard deviation of 12%. The correlation of returns is 0.6. What is the standard deviation of portfolio returns? All right, well, let me point out one thing before we do that. And that is, we have these two, we could find the weighted average, right? So if I told you this, if I told you that the stock portfolio had a return here that the bond portfolio, R sub B, that's a terrible R, was equal to 10%. And I said, okay, what's the return on the portfolio? Well, the return on the portfolio is going to be equal to, well, let's see, we have 30% in stocks, they're returning 20%, so I'm going to take 0.3 times 20, okay, plus I'm going to take, 0.7 times 10, and that's going to give me what, 13, if I did that right? So the return on the portfolio is 13%. If I do the same thing for risk, right, and that's what you see down here. Okay, so we're going to say, what is the weighted average of the risk of the individual assets, or in this case, asset sectors in the portfolio? Well, I would get 14.4. Okay, when is that true? Well, the mother concept here in all this portfolio theory is that the weighted average of the individual assets, the weighted average of the standard deviation of the individual assets in a portfolio, okay, which in this case is 14.4, is the absolute maximum of what the variance or the standard deviation of the portfolio is going to be. This will only be the case. This only applies if these things are perfectly positively correlated. Okay, if they're not perfectly positively correlated, then we're going to get a result like what we see here, okay, where the standard deviation of the portfolio is 12.9. So notice that it is lower, okay, than the average standard deviation of the underlying securities. That is the benefit of diversification. So when your mother told you there's no such thing as a free lunch, she was either lying or she didn't know about portfolio diversification, and we'll just assume it's that one, right? Anyway, so the portfolio diversification, what we could see if we had time, and actually we're going to talk about it in a moment, but if we now change this and we said, well, keep everything the same, but let's change the correlation to 0.2, okay? And then let's change it to, minus 0.2. And what you're going to see is that the lower the correlation, the lower this standard deviation of the portfolio is going to be. So the mother concept again, the lower the correlation, okay, the lower the standard deviation of the portfolio. The lower the correlation, the lower the standard deviation of the portfolio. Stated equivalently, okay, the lower the correlation, the greater the diversification of risk. The lower the correlation, the greater the diversification of risk. All right, so let's think of this in pictorial terms here. Okay, so if we have two stocks, stock A up here and stock B down here, well, if we're 100% in stock B, we're right there. If we're 100% in stock A, well, that's our risk-return combination. So we're in the return and risk space here. So if these things were perfectly positively correlated and I wanted to come up with a portfolio that was half A and half B, this is where it would fall. In other words, if they're perfectly positively correlated, portfolio combinations are going to lie on a straight line between A and B. Make sense? Okay, so that would say, well, okay, the risk of the portfolio, okay, is going to come down here, right? And the return on the portfolio that's 50% A and 50% B is going to come over here, and we'll call that, 8% or whatever it looks like. All right. Now, what would happen? And this, of course, is with correlation. Ooh, that's a terrible row. So this is with correlation equal to +1. So all the portfolio combinations lie on the straight line. What would happen, though, if we went in and said, what if we had correlation equal to, 0.3, right? So instead of being perfectly positively correlated, they're positively correlated but imperfectly. Well, then, if we had 100% A, we'd be up here. If we had 100% B, we'd be down here. But the portfolio combinations would be reflected in this little bowed line that I'm drawing here. So now, if we wanted to be 50% A, 50% B, instead of being over here, I'd be here, right? The return is unimpacted, right? Return is not impacted by diversification, okay? But risk is, right? So the risk was over here, now it's down here. So that is the diversification of risk. And then, of course, if I could find, a correlation equal to minus 0.3, well, then I'd get an even bigger bow, right? And in the limit of all this, getting rid of my chicken scratch, in the limit of all this, we could actually find perfectly, if we could find perfectly negatively correlated securities, then we could do something that's really pretty amazing. We could take two risky assets, a stock A and a stock B, combine them in such a way that we create a riskless portfolio. So we could get rid of all risk. Now, no one is claiming that there are, fundamental assets, that is, things that occur naturally, excluding derivatives, in other words, that are perfectly negatively correlated. But at the same time, there's almost nothing that's perfect. A share of IBM stock and diversifying yourself by buying another share of IBM stock, right? So what happens is in the real world, when we look at fundamental or real securities, then they're going to be somewhere between these two. What we want to do is we want to build portfolios that take advantage of this. If it doesn't impact return, but it does reduce risk, well, that looks like a free lunch to me. All right? So the idea here, correlation and risk reduction, the lower the correlation, the lower the standard deviation of the portfolio. All right? Okay, let's look at a question real quickly. An asset has correlation with a portfolio's return that is less than 1, okay, but has the same standard deviation. So what we've got is standard deviation for the portfolio, standard deviation for the asset, okay, are both equal to, we're going to call it 0.2. All right? So the portfolio and the asset have the same standard deviation. Okay, we're going to take some of A and we're going to add it to the portfolio. Okay, what's going to happen to the risk of the portfolio? Even though they have the same standard deviation, what's going to happen? Well, let's see, is risk going to increase? Well, no, risk is not going to increase, right? So there's same standard deviation. May increase or decrease? No, that's not true either. Okay, the correlation is less than 1. It's 0.99 down to -1, right? Well, what that says is adding some A to the portfolio P is going to lead to a decrease in the standard deviation, right? And it just falls out of the mathematics. Once we put this portfolio together, so think of it as 90% in the old portfolio, 10% of asset A, same standard deviations, but a correlation, anything less than 1, okay, you're going to get a reduction in the standard deviation of the new portfolio. All right? So portfolio risk and return, make sure that you understand that. Like I say, I think that is one of the mother concepts in finance, so be really careful in how you think about that. All right, I want to talk for just a minute about, this is Markowitz theory. This is what the classic picture for what we would call portfolio theory as opposed to capital market theory, which comes later. So what Markowitz did to win the Nobel Prize was he went out and he said, okay, let's find some securities, right? So he went out and found a bunch of risky assets. These are all stocks when he did it. And he calculated, he followed them over some period of time, and he calculated the standard deviation of each stock and the expected return of each stock or historical return, and they mapped into what we see there. Then in the next stage he said, well, now let's take 2 of these. Okay, so let's take this one and let's randomly choose another one, maybe here, and let's form that into a portfolio, right? So, and he was forming equally weighted portfolios. Well, what's going to be the risk of the risk and return combination for those 2 assets once they're put into a portfolio? That is, they're measured together. Well, I don't know, but it's not going to fall on a straight line, right? There are no perfectly positively correlated stocks. So there's going to be some bow associated with that, right? Sometimes the bow is going to be little, sometimes the bow is going to be big, but what we're now going to get is a point out here. And then we're going to do that with this one and this one, right? And we're going to get this, so we're going to get a point out here. So in the end, what we're going to get, okay, is points that look like this. Okay? Well, then what Markowitz did, he said, well, now let's take those and let's take one of those and another of those and do the same thing, right? So we're going to take those 2 asset portfolios and we're going to put those together. Okay? And eventually what he gets to, getting back to my regular color here, what he's eventually going to get to is that he runs into a frontier, all right, that looks like this. So the assets end up, I'm trying to change my font here. So we can push these out here like this, but he's not going to find anything out here, right? There's not a dot there. We end up with this solid line. Okay, well, this solid line is special in the world of finance, right? So this is the Markowitz efficient frontier. Okay, well, it's efficient. What does that mean? I think it's actually defined on the next slide. But what that says is that for any point on this line, okay, maybe this one, okay, that the portfolio represented there has the highest return for a given amount of risk or the lowest risk for a given amount of return of any available securities. So getting back to a prettier picture here, what we can see is that we've got this efficient frontier. It starts here. That portfolio is called the minimum variance portfolio, the MVP. has some special significance, and then we have all these other risky asset portfolios that run up here like this. All right? So what we see is the solid line here is the Markowitz efficient frontier, and that's the starting point for what we're ultimately going to call, here's again defined for you, I think here. So efficient frontier is a set of portfolios among all possible portfolios of combinations of individual risky assets that offers the highest expected return for each level of risk, which I think is what I said. So anyway, it's this line that's shaped like this. Okay, so that's the Markowitz efficient frontier. You want to make sure that you have a handle on that. Okay, one other thing we need to note, well, let's, I guess we have a little problem to work first, and then one other construct, and we will be done with this particular reading. So, efficient portfolios, here's a problem, and hopefully this is an easy one for you. Which of the following portfolios is least likely to be on the Markowitz efficient frontier? So, they give you portfolios A, B, and C, expected return, standard deviations. Okay, so which one of these three is least likely to show up on the frontier? A with a 10 and 12, B with 12 and 16, C with 14 and 15. So what's that going to be? Take just a second, see if you can figure it out. All right, you get it? Did you write it down? A, B, or C? Okay, so there we go. Why is this one the least likely? Well, we can have, there's no evidence that 10 and 12 isn't going to be on the frontier. And 14, we have a higher return, okay, on portfolio C, and we have a lower amount of risk, right? So we don't really know if A and C are on the frontier, okay, but we do know that portfolio B would be off of the frontier if those two were on, right? So it might be that all three of them are off, but this is certainly a dominated portfolio in any sense. So anyway, so the point here is if you have lower return and higher risk, well, you're just not an efficient portfolio, and that's not where you want to be as an investor, all right? Okay, one final concept here. Okay, I think I already said that. So, and that is, we've talked about straight lines, right? And there's two situations where we're going to get straight lines that I think show up and sometimes confuse people. So one of them was when we said, okay, we've got, asset A up here and asset B down here, and if they're perfectly positively correlated, then we get this straight line combination, all right? That's true, but that's not what we're talking about here. This actually falls out of a different part of the formulas, if you want to think of it that way. So now what we're talking about is having any risky asset. So any risky portfolio here, we'll call it portfolio P. Okay, and what we're going to add is the idea of a risk-free asset. Okay, now what are the attributes of a risk-free asset? The attributes are, one, the standard deviation is 0. Okay, but also the covariance of the risk-free asset with all other assets is 0. It doesn't vary, right? You get exactly what you were promised. So, it has 0 variance and 0 covariance. And what that means is that we are going to get, if we say, well, I want to combine any portfolio P out here, okay, any portfolio P with the risk-free asset, then portfolio combinations there will lie on a straight line. All right? So another way to form a straight line, you can either have perfectly positively correlated securities, okay, or you can have a riskless security. You're going to get a straight line with all the portfolio mathematics. So what does this say? Well, if we're at this point, okay, down here, that says I've got half my money in portfolio P and the other half in the risk-free asset. Okay, well, if I really like portfolio P, maybe I want to move out. So I'm going to move closer to P, or maybe I'm going to be all the way out here at P. But what if that's not enough risk for me? Well, what I could do, at least in this tightly woven theoretical world, is I could move up above that, right? So I could move up here by doing what? Putting all of my money in P and then borrowing at the risk-free rate, or shorting T-bills if you want a practical answer, right? So I can short T-bills and move up here, all right? Well, when we do this, all right, when we take a risky asset, okay, so any risky asset here, okay, and we combine it with the risk-free rate, and we form the resulting straight line like this, okay, that's called a capital allocation line, all right? So we can move up and down this line through portfolio combinations down here, 100% risk-free, here 100% in the risky portfolio, here 50-50, here 150 and minus 50, right? So we can move up and down this line, okay, as a capital allocation line. So how are we going to decide where we as an individual investor want to be? Okay, well, we're going to do that by deciding what our risk-return preferences are. And our risk-return preferences, if you think way back to the econ material, are going to be determined by indifference curves. So what we see here is that investor A is And again, more risk averse. That's hard. He's risk averse. Okay, a better language there would be less risk tolerant. Okay, so the investor A is more risk averse than investor B. He has a steeper slope to his indifference curve, which says for this investor to take more risk, requires a lot of return. Investor B is also risk averse, but has lower risk tolerance. So to get him to move from out here to from A portfolio to B portfolio, well, you have to offer him the required increase in return per unit of risk is lower because of the slope of his indifference curve. All right, and of course we studied those back in economics. All right, it turns out that this CAL, the CAL or CAL, capital allocation line, is an important construct that's going to show up very early as we make the transition from portfolio theory, which is Markowitz, to capital market theory, but that's for another reading. Hope you get on top of this stuff. It's great practice. Make sure that you're okay with the basics. The stuff that's in this reading absolutely will show up on the exam. Now, it may not be the answer to the question, but you're going to have to use and it will be the answer to some of the questions, but you're certainly going to have to use the tools in here to answer other questions, both in portfolio theory and everywhere else in the curriculum. So, means and variances and covariances and, all that sort of stuff. This is just really fundamental to the CFA curriculum. So if you don't feel good about this particular reading, I would go back and work some more problems before I moved on. Good luck.